Hello there. Today we're going to solve NAS level accounting paper 1, 2, February-March 2022. We have 1 hour and 30 questions. So 2 minutes per question. Not bad. I think it can easily be done. No problem with that. If you have covered the whole syllabus, it shouldn't be a problem. Which actions are taken in respect of the totals of 3-column cash book at the end of an accounting period? Cash and bank columns. Okay, so a cash book is a ledger account for cash and bank accounts. So we will balance them. We'll not just total them, we'll balance them. The discount columns will just be total and then transferred to their own accounts. Okay, because cash book is not the ledger account for the discount columns. It's just listed there, but the real entry of the discount accounts will be in their own accounts. Does that make sense? Okay, let's move on. Which item is an example of capital expenditure? Cost of repairing to an office building, cost of repairs to an office building, cost of repainting business name on delivery. You see, most of the times when they say re something, they're just maintaining their non-current assets, and they're very likely not capital expenditures. There can be exceptions, right? But yeah, mostly repairs, repainting, refurbishing, whatever you say, fixing anything, bringing it back to its original condition. That's not capital expenditure, that's just revenue expenditure. Legal costs paid to purchase an office building, that is capital expenditure, part of the definition. Capital expenditure is the amounts of money spent on purchasing, acquiring non-current assets, delivery of them, the legal cost associated with the purchase. So any cost relating to the purchase itself. All right. Number 3. On July 1st, 2021, Tim bought a delivery vehicle for $10,000. He paid an additional $900 to have racks fitted inside. You see, that's an addition, that's an extension. And $800 for a year's insurance, and that is the maintenance. Insurance is required to run the motor vehicle, right? So the running cost, that is revenue expenditure, and this one's capital expenditure, okay? Tim provides for depreciation at 10% per annum. A full year's depreciation is charged in the year of acquisition. What was the total for expenses recorded in Tim's income statement in respect of the van for the year ended 30th September 2021? Be a little careful. If you're coming from Igcse, what they will do is they will trick you a bit more, okay? So first of all, let's figure out what's the cost of the van. What should be capitalized? 10,000 plus 900. That we should capitalize. 10,900. They've told us full year's depreciation will be taken. Although we bought it in July, we used it for July, August, September, just 3 months. But we're not going to prorate that. We're just going to take the full amount. So 10,900 plus, times 10% is 1090, right? Quick maths. And the 800 insurance, well, we won't charge the full amount to this year. Expenses, you have to assume, right? It's not like they will tell you. You have to break it down. You have to prorate that. Why? Because of the matching principle. You have to follow that. Yeah, so 800 times what, 3/12, right? 3 out of 12s. Yeah, because that's just 3 months. We use that insurance for 3 months in the current accounting year. The rest of it is prepaid expense. 800 times 3/12. Let me just check. 800 times 3 over 12, 200. And that is in total 1090 plus 200 is 1290. There we go. Number 4. A business has a year end of 31st December. It purchased a non-current asset on 1st January 2020 for 100,000. The asset was depreciated using the reducing balance method. Be careful, reducing balance method. 20% per annum. All right. It was sold for 40,000. What was the loss on disposal? To calculate the loss on disposal, we have to first find the net book value of that asset at the time of disposal. How would you do that? Well, the value of the cost of that asset, the cost you paid for it, minus accumulated depreciation. Accumulated depreciation is the total depreciation provided so far. So in year one, well, we sold it after 2 years, right? We used it for the whole year of 2020, 2021, and then the third year, at the beginning of that, we sold it. So we used it for the whole 2 years. In year one, the depreciation is going to be 100K times 20%. That is 20,000, isn't it? And then in year two, the depreciation is going to be, well, 100 minus 20. You're going to first take the net book value on that date and then calculate the percentage of that. 10K minus 20K, that is 80,000, times 20% again. The percentage doesn't change, the amounts change. You see, in the first year it was 100,000, now it's 80,000. So that's, let's see, 80,000 times 20% is 16,000. In total, the depreciation so far is 20 plus 16, that is 36,000. What's the net book value? 64, right? 64,000, that's the net book value at the date of disposal. We think that's the value we'll get for it. But when you go to sell it, you realize it's 40,000. The machine was sold for 40,000. You thought it was 64,000. You have under depreciated. You haven't depreciated enough. So you have to further, well, that's a loss. So loss of 24,000, right? That's the difference. And so you'll put that under your expenses. Why would you put that under your expenses? Because previously you under depreciated. You only depreciated 36,000. You were supposed to depreciate it by 60,000. Now that's going a bit deep into the concept. You should know that net book value at the date of disposal, you look at that and you look at the amount you sold it for, right? If you sold it for less, it's the loss by the amount, by the difference, right? And if you sold it for more than the net book value, that's the profit on disposal by the difference. What is entered in the sales ledger control account? Cash sales will never go into sales ledger control account because another name for sales ledger control account is total trade receivables, right? So cash sales are not your trade receivables, right? It's not part of it. Increase in provision for doubtful debts. Increase in provision for doubtful debts. Provision for doubtful debts has its own account. Increase in bad debts, increase in irrecoverable debts, we may have to enter that here. But increase in provisions, no, that's a separate account. We don't change our receivables just because provisions are estimated, right? So we cannot change our actual receivables with the estimates. It has its own account. Return inwards, sales returns, yes, they can appear. If you remember the format, you will realize that these two don't appear. This third one appears, and there are multiple ways to make sense of it as well, right? Number 6, a trial balance included a suspense account. The bank balance of a trial balance included a suspense account, so there was a difference on the trial balance. The bank balance of 28,412 had mistakenly been entered as an overdraft and placed on the credit side as 28,142. Okay, so we're making, we're reversing the entries here. We're supposed to put it on the debit side. We instead put it on the credit side. And not just that, we put it by the wrong amount, right? There had also been an addition error, and the debit side of the trial balance had been undercast by 450. Let's have a look at the effects of these mistakes. So the bank balance of 28,412 was supposed to be on the debit side. This was supposed to be on the debit side, but we didn't put it. We instead put it on the credit side. So first of all, the first effect, this will cause our debit side to go down, isn't it? Because it was supposed to be there, it wasn't. We didn't put it there. This, by putting it on the credit side, will further cause a difference between the debit and credit side, and it will further cause our debit side to go down as compared to the credit side. Now, credit side is getting bigger by that amount, which was not supposed to happen. Well, obviously, if credit side is getting bigger, debit side is getting smaller. I hope that is making sense to you. Look, you need background knowledge for this, right? You need to know what I'm talking about. You need to have some basic knowledge of how trial balances trial balance works. Okay. There had also been an addition error, and the debit side of the trial balance had been undercast. So this causes a shortage on the debit side. This causes a shortage on the debit side, and then this further causes a shortage on the debit side. So all of these are working against the debit side, all these errors. Well, let's just add them up, and then, well, which entry in the suspense account will correct these errors? Okay, now this is interesting. First, let me just add this all up. 28,142 plus 28,412 plus 450. That is 57,004. Now, all of that is short on debit side. In your trial balance, when you have the trial balance, your debit side will have the suspense account entry, right? Isn't it? 57,004. That will be on the debit side because debit side is shorter. It always goes on the shorter side. Even in your suspense account, the suspense account, you will see that the difference on trial balance will appear because it appears always on the same side. You don't change the sides. Like if your debit side is smaller on the trial balance, you put the same thing on the suspense account. So you start with the debit entry 57,004, and to fix these errors, right? To fix these errors, you'll make credit entries in the suspense account, right? That will cancel out that will make the suspense account balance at the end. Again, this is how the suspense account works to fix the errors, right? You have all these errors which appear on the debit side as a difference, and then once you fix them all, they will all go over here, which will have a canceling effect on this 57,004. And once suspense account balances, we know that all our errors are cleared. So to fix these errors, we will need to put a credit entry in the suspense account. Which statement is correct? The balance on the irrecoverable debts account is carried down to the next accounting period. No, it's transferred to the income statement. The balance on the irrecoverable debts account is treated as an expense in the income statement. Yeah, that looks like a good choice. We transfer it to the income statement. The total of irrecoverable debts that we transferred. The balance on the provision for doubtful debts is calculated before deductions. No, it's calculated after. The balance on provision for doubtful debts account is not included in trial balance. That's wrong. It is included. Why not? The following information is available for business at 31st December 2021. Okay. Total amount paid during the year ended 31st December 2021 is 11,500. What is the amount to be included in the income statement? All right, interesting. So there's this arithmetical way to do it. There's a T account way to do it, right? We can do the arithmetical method. So we start with what's paid. That's paid 11,500. We paid that. And now we adjust for what belongs and what does not belong. So general expenses in arrears 1st January. That means in this at the beginning of the year, this was owing. This 420 was unpaid from the last year. And now when we paid 11,500, this payment was not relevant to us. The 420 that we must have paid during the year, it belonged to the previous year because previous year it was unpaid. When we paid our 11,500, that included the 420, but this payment did not belong to this year. Does that make sense? You need to get rid of that because this 420 does not belong to this year. It is for the previous year. General expenses in advance. We paid something last year, which is 240. We didn't pay it within this 11,500. We didn't pay it during the year, which is 11,500. So this 240 was paid in the the last year, but it belongs to the current year. It was paid since the year when the year started. It was already paid, but we have to include it, right? Although we didn't pay for it, but we have to include it because of the rules. We have to include what belongs to this year, what was incurred, what was actually what actually took place during there. We have to include that, no matter we pay it or not. General expenses in arrears at the end. Now that means at the end there was some unpaid amount, 720. We are going to include that because at the end The unpaid amount belongs to the current year, and so we add it because it belongs to the current year, okay? And things paid in advance at the end of the year will have to be removed because it belongs to the next year. I hope you're understanding this. You're supposed to, right? 11,500 minus 420 plus 240 plus 720 minus 120. That's 11,920. D. The T account format. So I'll just keep it very simple. I'm not going to try to make it very nice and fancy. Just a little bit, just some rough working, okay? Even you don't have to work on it so much. Just make a little rough diagram and make a rough T account and work with it. General expenses 1st January. Now, when the year started, we had some expenses in arrears, and that's a liability. You should know that. Must have credit. Must be a credit balance brought down. 420 brought down. Why on the credit? Because it's a liability. Something paid in advance, that is an asset. All right, there we go. That is brought down. Two balances brought down. Next, we will also put the closing balances. Balance carried down, balance carried down, brought down, brought down. Now, your focus should be on the brought downs, not the carried downs, right? The brought downs ones, the opening balance for the next one. So at the end, what do we have? General expenses and arrears, unpaid expenses. Again, 720 on the credit because it's a liability, and this is an asset, current asset, because it comes under other receivables. 120, it's an asset. What else do we know about it? We know that we paid 11,500. That means bank credit and this one debit. 11,500. That is our expense. General expenses. And the the income statement transfer always appears over here because in the income statement it's going to be debit, or here it's going to be credit. We're transferring. And when you look at the balancing figure, that is 11,500 plus 240 plus 720, that's going to be 12,460. 12,460 minus 420 minus 120, that is 11,920. All right, we got the same answer both ways. Let's move on. When would the year-end value of inventory need to be adjusted? When inventory has not yet been paid for? When inventory has not yet been paid for, no, that doesn't matter. It doesn't matter if we've paid for it or not. We'll not adjust the value based on that, right? When selling price has fallen below cost. Okay, so, well, we will have to do that because it is an adjusting event, right? We had some inventory at the time, at the reporting date, and I believe they're talking about that topic. I hope that this is the topic they're talking about in this particular case. So it is a reporting event because the inventory we had at the time of the reporting date, we realized later on that that inventory was not worth what we thought it was worth at the selling price, which is the NRV, net realizable value. So we might have to go back and change it. It's an adjusting event. When the owner has recorded taking goods for his own use during the year. But then owner has already recorded and it was done during the year, right? So we don't have to adjust the value for inventory later on. So yeah, it's just two, right? Two only. That's the only option that makes sense, at least to me. Yeah. Number 10. A business had a draft profit for the year of 250,000. The following errors were then discovered. Depreciation charged 25,000. Charged was 25,000. The figure should have been 40,000. So we have to further reduce it by 15k, 15,000. Closing inventory for the period was undervalued by 10,000. Now remember this one thing. Closing inventory directly affects the profit. If closing inventory is undervalued, profit will be undervalued. To fix this, we need to add back 10,000. Why did I say what I just said? Closing inventory will what is the effect of closing inventory? If closing inventory is higher, the cost is going to be lower, cost of sales, because how do you calculate cost of sales? Opening inventory plus purchases minus closing inventory. So closing inventory, the higher it is, lower will be your cost of sales. So if, and it's vice versa, the opposite as well is true. Closing inventory, if it is undervalued, your cost of sales will be overvalued. If your cost of sales are overvalued, your profit will be undervalued. So closing inventory and profit, they move in same direction. If closing inventory is undervalued, profit is undervalued. You need to fix that by, adding back the 10,000, which was mistakenly undervalued, right? So 250 minus 15 plus 10, that's 240. What? 250. Oh, sorry, made a mistake in my calculator. Instead of 15, I put 12. All right, 245. Option B. Let's move on. Number 11. A capital account for a sole trader contained 3 entries in addition to the opening and closing balances. Okay. What did these entries represent? Okay, if you just know, if you have made a few capital accounts, you know that certain things appear on the debit side, certain things appear on the credit side. What appears on the credit side of a capital account? Things that increase owner's capital. And on the debit side, things that decrease owner's capital. Now, does capital introduce decrease owner's capital? No, it increases. It's supposed to appear on the credit side. That's wrong. Capital introduced. Again, capital introduced, no way, it cannot be on debit side because debit side reduces owner's capital, it doesn't increase it. Drawings loss for the year, this side makes sense. Capital introduced on the credit, this makes complete sense. Profit for the year cannot appear on the debit side because it increases owner's capital, not decrease. So it should appear on the credit side. Wrong. Let's move on. Number 12. The year end of a business is 31st December 2021. On 5th January 2022, inventory was counted and valued at cost 30,000. The following was then discovered. Goods purchased and received after the year end, costing 1,500, had been included in the valuation. So these goods were purchased and received after the year end. The year was ended. So we cannot include that, right? It cannot be included in this valuation. We did not have that at the time of counting the inventory at the reporting date, right? 31st December, that's when we close our accounts. On 5th January, we were counting the inventory and we mistakenly included the 1,500 worth of inventory that came in after this date. We are not supposed to include that, right? Only what was true during or at the reporting date. Only the facts at that time we have to include, right? What happened after that, we don't, okay? Well, if events after the reporting date, which is 31st December, gives you more knowledge, right, or clarifies a few things about the events present before the reporting date or at the reporting date, that's when you adjust. Okay, we cannot go that deep into the topic. We'll stick with the question right now. It included goods returned by a customer after the year end. They had a selling price of 900, which included a markup of 25% during the year. Okay, so this includes goods returned by a customer after the year end. Okay, so we didn't have these goods at the reporting date. We need to get rid of that, right? So our customers, the customer returned the goods after 31st December. They returned it after 31st December, and so goods came back into our premises. Well, what we did is we included that as well. Well, it wasn't true. On 31st December, we didn't have it, right? We have it now on 5th January, right? The following was then discovered. So, well, okay, they're playing with this as well. So 900 is the selling price. Do you remember that table? You put the selling price here, you put the cost price here, you put the gross profit here, and then you put the amounts here, the percentages here. The selling price is 900, cost is unknown, but we know the markup is 25. That means gross profit is 25% of the cost because it's markup. And so this must be 125. Just looking at percentage units, 125 minus 100, that's 25. You got to know this as well. I mean, I'm taking that as assumed knowledge. 900 divided by 125 times 100, That will give you 720. Okay, so 720, we included it, but it was not part of our inventory at this date, 31st December. Some goods included in the inventory costing $500 were damaged. They can be sold for 300 after repairs costing $100. Okay, so cost or NRV, right? Lower of cost and NRV. So we'll have to value this at net realizable value. The net realizable value here is, well, the expected selling price minus any cost of selling. So that is going to be 200. So um, instead of 500, it should have been 200. We have to reduce it by 300. Does that make sense? So 500 is included here. Instead of 500, it should have been 200 only. So we get rid of the 300. Hope that makes sense. Okay, let me just now calculate everything. 30,000 minus 1500 minus 720 minus 300. That's 27,480. 27,480. I got that from here. Number 13. A sole trader provided the following information for the year ended 31st December. What was the profit for the year ended 31st December? Okay. Non-current assets decreased by 25,000. Current assets increased by 10,000. Current liabilities increased by 12,500. Additional capital introduced during the year 20,000. Okay. So what we can do is, how do we calculate capital? Well, to calculate change in capital in this case, because we have the change in non-current assets, we have the change in current assets, we have a change in, so we can calculate the change in capital by doing assets minus liabilities, right? That's the kind of equation. So if our non-current assets plus current assets, they changed by 35,000 in total, minus the liabilities, the current liabilities changed by 12,500 in total. The total change in our capital is 35 minus 12,500. That's 22,500. 20,500. That's by how much the capital changed. Okay. Now we can apply that formula to calculate the change in capital. Well, how does it go? So we add the capital. We will not put opening and closing capitals, but we know that what causes change in capital, right? Because that's the total change. So what we do is we take opening not the opening, but we take the capital introduced. We subtract the drawings, if you remember, the magic formula, and you add the profit. We don't know about that. And that will cause the overall change of 22,500. Let's just solve the simple maths here. 22,500 minus 20,000 plus 13,000. It's going to be 15,500. Option C. Number 14. Which rule does not apply in the absence of a partnership agreement? Interest on partners' loans is charged at 6% per annum. It does not. Yeah, if there is no partnership agreement, we will not do this. Such a funny question, isn't it? Of course, this does not apply. No interest on capital is charged. Yes, if there is no agreement, the rule doesn't have to apply. There's no need for a capital because there's no agreement, right? If there's agreement, then there will be capital, interest on capital, there will be salaries, and the way the percentages for profits will be given, right? So these can apply if there's no agreement, and these will probably apply, but option A doesn't make sense. It's just something so random. All right. Number 15. P&Q and partnership sharing profits and losses equally. On 1st January 2021, the partnership had net assets of 410,000. At that date, R was admitted into the business on the following terms. Net assets to be revalued to 480,000. Okay. Goodwill was valued at 50,000. but will not be retained in the books of accounts, and there is a treatment for that. Profits and losses will now be shared. Okay, that's the sharing ratio. Previously, it was equally shared. What was the change in Q's capital immediately after R's admission? So let me tell you, net assets essentially means capital. Okay, assets minus liabilities, owner's capital. So if net assets were revalued to 480,000, that means they suddenly got 70,000 profit, right? Because their assets were revalued upwards, and their capital increased essentially. So they will take 50% each. What is the change in Q's capital? Okay, Q's capital. We're looking at Q's perspective only for now. So Q will get 35,000 from that. Okay, that'll be the rise in his capital. What about the goodwill? Well, if you don't want to retain it in the books of account, the method to solve this is, well, we give the partners the goodwill, the old partners, the original partners, the goodwill based on their original profit sharing ratio, which is 50%. So that is 50,000 times 50%, 25,000 each, right? And we subtract the new sharing ratio. Now there's a reasoning behind that, which we will get into at some later time. For now, you can just apply the method. 20,000. That's the way to do it, and it has a logical reason behind it as well. For now, we'll stick with the question, not go too deep into the concept. So for Q, the capital will increase by 40,000. It's going to be T. Number 16. X and Y are in partnership, sharing residual profits and losses equally. Partners are charged 2% interest on their drawings. Y is entitled to a salary of 10,000. The partners' drawings for the year were as follows. The profit for the year is given to us. How much did each partner receive as a share of residual? Okay, let's just do that appropriation of the profit, okay? 52,000, that's where we start. We need to subtract, we have to subtract the salary. Subtract the salary, and we have to add the interest on drawing, which is 2% of each of these amounts. 0.02 times 12,000, that's 240, and times 8,000, that's 160. 240 plus 160, that is 400. We have to add 400 in total. Anything else? I believe that's it. 52 minus 10, that's 42, plus 400, that's 42,400. Okay, that's not it. We have to equally divide it now. So this was just appropriation. Now we just divide the residual profit by 2. 21,200. Option D. Let's move on. Number 17. Which statements are correct? Dividends can be paid out of the general reserve. Yes, because general reserve is created from the revenue reserve, right? From the retained earnings, I mean, and it's a revenue reserve, so we can pay dividends out of general reserve if you wish to. Rights issues can be made from share premium account. No, we actually earn. We earn share premium from rights issue. We don't. Very often that's the case. This is the case with bonus issues. You make it out of the share premium account. This is correct. The general reserve can be created from, yeah, of course, 1 and 3. Number 18. A limited company had the following balances on 1st January 2021. The revaluation reserve, retained earnings. Profit for the year is given to us. The revaluation reserve, 20,000, was created 2 years ago from a revaluation of a property. The same property was revalued on 31st December 2021 with a revaluation loss of 35,000. Okay. So, well, this will cause the revaluation reserve itself to go to zero, and we will also recognize the 15,000 loss because we stay prudent. We know there's a potential loss. So far, the 20,000 was never recorded in our income statement. Why? Because it's just a unrealized gain. Uh, so we never recorded the 20,000. But then when we make a loss of 35,000, well, first of all, that cancels this one. And on top of that, it's a loss of 15,000 extra. So what we do is our profit for the year, we subtract 15,000 from that because it's a loss we should recognize. And we have to add, oh no, there's no adding. We also have to subtract the dividends paid. Let's do it. 105,000 minus 15,000 minus 40,000. That's, what am I missing? Oh, what am I doing? I'm sorry, guys. We also this is the retained earnings. We have to add the profit to that and do the rest of it. 142,000 plus 105,000 minus 15,000 minus 40,000. That's 192,000. Now, yeah, you can just just an advice, just a tip. You can only use the first three numbers, right? For addition, subtraction. Ignore the three zeros, and just put them back in at the end. Because here it's simpler that way. It saves you some time. All right. So you can do 142 plus 105 minus 15 minus 40. You'll get 192. Just add three more zeros. That's just 192,000. Well, just an advice. You can take it or leave it. It's up to you. Whatever you're more comfortable with it. The bank balance. The bank balance of a limited company was 390,000 before the following transactions took place. An issue of 50,000 new shares of zero point 0.5 each was made at a premium of 0.25. So in total, we got 0.75 from each share, right? A debenture of 100,000 was repaid. That's a negative cash flow. It's like cash outflow. We have to subtract it, obviously. A bonus issue of 100,000 shares. Bonus issue does not affect your cash or bank, right? Because it's made out of your share premium account. So, well, 500,000 times 0.75 is 375. So, we had 390,000, we got 375 from here, and we lost 100,000 from there. Again, you don't need to write the thousands in your calculator. 390 plus 375 minus 100. That gives me 665, and that means 665,000. We'll move on. 20. What might cause a decrease in a company's non-current asset turnover? All right. So non-current asset turnover would be your revenue over the non-current assets. So what would cause a decrease? Well, revenue over non-current assets. Increase in expenses will cause. Okay, so increase in expenses has nothing to do with it, apparently. Increase in sales revenue will cause an increase in your net current assets turnover, right? Because if your revenue goes up, the numerator goes up, denominator stays the same. The formula, it gets better. It doesn't get worse. We're talking about the worst scenario. Purchase of new non-current assets. Yes. So if this one goes up, the denominator goes up, and the revenue stays the same. Denominator is going up. Whenever in a fraction denominator goes up, the final answer goes down, right? Because we're dividing it by a bigger amount. So that is the answer. Number four, option D, selling non-current assets that will reduce the non-current assets and will improve your non-current asset turnover if the revenue stays the same. Okay. Next one. Number 21. The following information for a limited company at 31st December 2021 is available. Ordinary share capital, retained earnings, 8% debentures. Retained earnings at 1st January 2021 were 82,000. That's the opening retained earnings. An interim dividend of 45,000 was paid on 1st May. What was the return on capital employed for the year ended 31st December 2021? Return on capital employed is profit before interest and tax over capital employed. In this case, what is the capital employed on 31st December? We have this capital employed, capital employed. Okay, so these two will be part of capital employed because that's capital plus. Well, there are no non-current liabilities, so we just add up the capital. Oh wait, there is a non-current liability. So that's the total of what? 300, 400, 510,000. That is your capital employed. Why? Because capital plus non-current liabilities. And that is 510,000, okay? That is capital employed. Profit before interest and tax. Well, the profit, okay, interesting. The retained earnings at the beginning is given to us. Retained earnings at the beginning. This was paid as a dividend. That should reduce the retained earnings. Profit for the year, we don't know about it. Should increase the retained earnings. And after all that happened, our retained earnings had 110,000. To find x, we will do some basic maths. 110 minus 82 plus 45. That's 73. That must be the profit. But this is profit after interest, so we have to add back the 8%. 8% debentures, we need PBIT, profit before interest and tax. That is profit after profit after the interest. So 73 plus 8, profit before interest and tax. That is 81,000, right? That's the profit. Okay, let's put that in the formula. 81,000 over 510,000 times 100. 81 or 510 times 100 is 15.8. And it's option D. All right, let's move on. Number 22. Which statements about stepped costs are correct? So they're, okay, fixed at a range of activity levels. Fixed within a range of activity levels. Yes, because then they increase, they change as activity. Up to a certain level, they are fixed and then they change. Fix whatever the level of activity, that's just fixed costs. Include fixed costs only. Yeah, that sounds good to me because it's only about fixed costs. You know, the thing is, it looks like this. So let's take that as graph. That's output, and that's cost. So it looks like that. It's fixed. You see, costs are fixed up to that output, and then suddenly they go up like a step, and then go up, right? So it's only about fixed costs, right? Nothing to do with variable costs here. It does not include variable costs. 1 and 3, option A. 23. A worker is paid $15 per hour for working 8 hours per day. Overtime is paid at a rate of time and fifth. Time and the fifth. What does that mean? That means 1/5, right? Time and a fifth, yeah. So whatever they normally get plus 1/5 extra. So they get a rate of time and a fifth. Time means $15 per hour, and then a fifth of that extra for every overtime hour worked. Now that essentially means the basic pay, which is In this, the way they put it, they mean time, the basic pay, and the fifth, which is 20%. It's the same thing in different words, okay? A productivity bonus is also paid at the rate of $21 per unit for each unit produced in excess of 12 units per day. Anything above 12, they get $21 each for each unit. Last Friday, the production worker worked 12 hours, so 8 normal hours and 4 extra hours, okay? And you should know that for extra hours, you get 20% extra money. And he also produced 2 more units. How much did he earn? So for out of the 12 hours, for 8 hours, he got $15 each. Plus, for the remaining 4 hours, he got, well, he got 15. Plus, for the 4 hours, he also got 15 times 1/5 or 0.2. That's 20%. Does that make sense? I hope it does. Plus 21 for each unit. That is 21 times 2 extra units. All right. Okay. Let's just add it all up. So for 8 hours, he got 15, the normal price. Plus for the 4 hours, he got 15. And for the 4 hours, he also got 15 times 0.2. So 20% of the 15 as well, in addition. Okay. Plus 21 times 2. That is 234 in total, D. This was one way to do it. You may have another way to deal with that one. It's up to you the way you put it, but at the end the idea is the same, right? Number 24. A retailer made the following purchases of inventory in October. So he made a purchase on 5th, 12th, and 23rd October. These are the quantities, the unit prices are given, the total prices are given, okay? The unit prices don't change for the first two. There's a change in the third one. There was no opening inventory. The business uses first in, first out method of value. Method to value its inventory, first in, first out. Okay. In October, 200 units were sold for $900 each. What was the gross profit for October? All right. 200 units were sold for 900 each. What are the sales? 200 times 900. 200 times 900. Yeah. That's 180,000. 180K, that's the sales. Minus cost of sales, well, first in, first out, right? So the 200, the 200 sold will be coming out of this 50, 50, 100, and then 100 from here. So the cost of sales is going to be 25 plus 25. So all these, the whole amount here, and only 100 out of that. So 525 times 100. Does that make sense to you? So 525 times 100 plus 25,000 plus 25,000. That is 102,500. That's the cost of sales. So we take the costs of the first goods purchased, right? Because there's a change in the cost. We didn't take 150 from here and then 50 from here. We took 50, 50, and 100. That makes it a total of 200 units which were sold. So that's the cost of sales. Okay, sales minus cost of sales. That's 77.5. 77,500. Option C. 25. A company has two departments in its factory. The details are shown. What is the fixed overhead absorption rate per hour in the machining department? In the machining department, the budgeted fixed overheads are 180,000. Budgeted hours 6,000. Well, the fixed overhead absorption rate per hour in the machining department. Well, take the machine cost divided by 6,000. And I'm surprised, is that it? Yeah. That's all the question wanted from you. So the total fixed cost in machining is 180,000. The budgeted hour is 6,000, so we have to absorb it to each hour. Just divide it and you'll get 30. Should be the answer. Let's move on. 26. What would cause overheads to be overabsorbed? Okay, overhead absorbed is greater than overhead budgeted. But is that a cause of it? No, actually, no, that doesn't make sense. So first saw that was a bit confusing, but that doesn't make sense. Overhead absorbed is greater than overhead budgeted. We have to compare overhead absorbed with the actual ones, okay? Overhead, so what was incurred, that's gonna matter. Overhead incurred is greater than overhead absorbed. That would be under absorption. Overhead incurred is less than overhead absorbed. That means we absorb too much, and that is overabsorbment as compared to the real overheads, right? The actual overheads incurred were less than the overhead that we absorbed. We attached to each piece produced. Right, let's move on. 27. A company has the following information for producing 2,000 units of a product. What is the contribution to sales ratio? Okay, so first let's calculate what is contribution in this case. So contribution is sales revenue minus the direct, the variable costs. Remove that, remove that, remove that. All these are direct, remove it. Other variable cost, remove that as well. Leave the fixed overhead. So 85,000 minus 30,000 minus 14,000 minus 2,500 minus 10,200. That's 28,300. And that is contribution, right? What is sales? 85,000. That should give us contribution to sales ratio. It's 28,300 over 85,000 times 100 gives me 33.29. And that's our contribution to sales ratio. The following information is available about two products, product 1 per unit, product 2 per unit. So product 1 requires material X, material Y, and some direct labors. Production is planned to be 100 units of each product. 700 kilos of material X and 400 kilos of material Y are available. A total of 800 direct labor hours can be worked. What are the limiting factors? Limiting factors is when you have a limited resource, right? So we're planning to make product 1 and product 2, and that's what they require, okay? So to make product 1, we need 200 kilos, 2 kilos each, and we're gonna make 100, so we're gonna need 200 kilos of material X, and we're gonna need 400 kilos of material X for the product 2. For product 1, we need 200 kilos. Product 2, we need 400 kilos. Product 1, 200 kilos. And in total, we need 600 kilos. Do we have enough of that? We do. We have 700. That's not a limiting factor then, right? We don't have any problem with that. What about material Y? For product 1, we need 300 kilos in total. For product 2, we need 100 kilos in total because I'm making 100 units, right? In total, we need 400, and that's exactly what we have, right? I believe the only option is going to be direct labor only, because this is not true. We know this is not true, and it cannot be all three because these two definitely aren't. Still, let's have a look at it. So 3 hours per unit, and we have 100 units to make. So 300 plus 600, that is 900. That's what we need to make both of them. But it's limited. We only have 800, right? So we'll have to allocate the hours in the best way possible. The question was about what is the limiting factor? It's the direct labor, okay? Because they're not enough to produce what we want to produce. A company provides the following information about its product. If the business charges, okay, what do we have here? Sales price, variable, fixed. Okay. If the business changes its production method, contribution will increase by 10% and fixed cost will increase by 5%. What would be the effect on the break-even point? Okay, right now the break-even point is given 360 units. Let's check out what will be the break-even point if we follow these changes. If the business changes its production method, contribution will increase by 10%. So contribution right now is 60, that's right now, but it goes up by 10%, that's going to be 66. Fixed cost will increase by 5. Well, increase that by 5%, 21,600 times 105%, that's 22,680. How do you calculate break-even point? 22,680, that's the fixed cost after the change, divided by the contribution per unit after the change as well. That gives me 344 because it's 343, but we have to round it off to the whole unit. We're talking about break-even point, so it's full pieces. Okay, so it seems like our break-even point goes down by 16, right? Decreased by 16. And it looks good. Why? Because the lower the break-even point, it's better for the business. Okay. Number 30, last question. What are possible limitations of a budgetary control system? Budgets are based on estimates. Yeah, so that is a limitation because it's all estimated only. Budgets may lead to staff demotivation if they are, let's say, a little too unrealistic, they're maybe too hard to achieve, and those kind of budgets will demotivate staff. That's true. Budgets may prevent managers from being creative. That's also true. So they will stick with the plan strictly. Very likely, strictly they'll stick with the plan because they need to meet the budgets. That's what they care about. They will be missing out on some other potential steps they can take to benefit the organization. Perhaps they won't because they are playing it safe and they want to stick to the budget, right? They cannot get creative. They don't have a space for that, right? So yeah, budget kind of constrains them to meeting certain targets. Okay, that's it for this one. If there are any questions, let me know in the comments. Hope you have a nice day. Take care. Goodbye.